I view the world as defaulting. The entire global financial structure is in the process of defaulting. So I think it's a no-brainer. You just buy physical gold, you buy physical silver. You will have something when the smoke clears. And that's one reason why many of these central banks have been buying gold very, very strongly for the last 2 or 3 years because they understand where this goes. They're going to end up with big black holes within their balance sheet that used to be dollars. So they're trying to replace those with something that's real and something that will go up in purchasing power as all these fiat currencies collapse.
The share of U.S. Treasury holdings belonging to Japan and China has decreased to the lowest level on record due to increased debt issuance by the U.S. and efforts by the two Asian nations to prevent their currencies from falling below historic lows. As of June, the top two holders of American debt possessed $1.94 trillion in Treasury securities. This amounts to roughly a quarter of all U.S. debt held abroad, but just under 8% of the total. This figure is significantly lower than the high point in 2007 when the two countries collectively held 25.4% of U.S. debt. While the BRICS nations are restraining the accumulation of dollars in their reserves, even allies of the United States are gradually following suit. The primary concern among U.S. allies is the escalating $34 trillion debt crisis, which is rapidly becoming uncontrollable. This debt burden will particularly impact countries that hold substantial amounts of U.S. dollars in their central banks. Bill Holter emphasizes the considerable borrowing requirements of the U.S. Treasury and the potential risks associated with holding significant amounts of dollars. This concern has prompted many central banks to bolster their gold reserves. Central bank demand for gold, a significant driver of its value in recent years, continued to grow in the fourth quarter, with an additional 229 metric tons added to global official gold reserves. This brought the annual net demand to 1,037 metric tons, just shy of the record set in 2022 at 1,082 metric tons. Global official sector gold reserves are estimated to now stand at 36,700 metric tons. Yet Bill argues that unlike fiat currency, gold possesses intrinsic value and cannot default, making it a preferred asset during times of economic uncertainty. Of course, the fact that gold and silver cannot default contrasts the world's hyper-indebtedness, primarily driven by the United States. We will present clips from Bill Holter's interview with SOAR Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Foreign buyers, I mean, look at Japan and China. They were the two biggest holders of treasuries. They've been bleeding their treasury holdings down for years. And just look at the BRICS. Why is there such a thing as the union of the BRICS? The whole idea behind it is they want to get out from under the boot of the US dollar. Because they understand that the dollar is strictly a fiat currency. It's a Ponzi scheme. And I mean, if you listen or read any of Putin's speeches, you'll hear him every time say, we want to do business, but the trade that we do, we want to be fair trade and fairly settled. In other words, they want to trade something real for something real, as opposed to something real for something that's nothing. And that's what the deal is. I mean, the U.S. does not. We have a huge trade deficit because we get products in and we send freely printed dollars back out, and that's why there is a BRICS, because they want to get away from. Their view is the danger of holding dollars, and that's one reason why many of these central banks have been buying gold very, very strongly for the last 2 or 3 years, because they understand where this goes. They're going to end up with big black holes within their balance sheet that used to be dollars. So they're trying to replace those with something that's real and something that will go up in purchasing power as all these fiat currencies collapse. I don't think gold has a new role. I think the role of gold is money and everything else is credit. I mean, J.P. Morgan testified close to those words in Congress. The reason you want to own gold, or the reason you want to own silver, is because they cannot default. And what we talked about earlier, the world being, or literally the whole world, but led by the U.S., is hyper indebted, and we're moving into the phase, and you're already starting to see it. We're moving into the default phase, and that's why you want to own gold. That's why you want to own silver, because in a world that is defaulting around you, gold nor silver can default. And it goes back to Richard Russell, for years and years and years, said that when when it finally blows up and goes down, the one who loses the least will be the winner. There's not going to be any outright winners that profit from the collapse, but there will be those that have gold and silver. They will have capital when the system reboots, when the bulk, the majority, especially if you agree with the great taking, which I do, because I do believe that that's the plan, is to basically take your assets. If you have capital when this thing reboots, your family will have wealth for generations upon generations.
The remarks regarding potential rate cuts align with the prevailing sentiment at the central bank, suggesting that while further rate hikes are improbable, the timing and pace of any cuts remain uncertain. Just a few weeks ago, markets were anticipating a high likelihood of a rate cut during the Federal Reserve's upcoming meeting on March 19th to 20, as indicated by Fed funds futures bets evaluated by the CME Group. However, those expectations have since shifted, with the probability now leaning towards the June meeting and even a possibility of waiting until July, standing at about 1 in 3. Bill emphasizes that if the Federal Reserve were to proceed with rate cuts during the March meeting or subsequent gatherings, it could trigger a sequence of events leading to a depreciation of the dollar. Concerning the role of gold, he suggests that while the Fed may not independently initiate rate cuts, external pressures could compel such action. A substantial dollar devaluation might prompt the Fed to raise rates to stabilize the currency. However, this decision could adversely impact an already fragile economy, potentially leading to a systemic event due to the significant debt burden. Let's get back to the interview.
Let's say in the March meeting, between now and the meeting, they decide we're going to cut rates. I don't think they will, but they decide that they're going to cut rates. You would then see weakness begin in the dollar, and I think that would pretty much push the boat from shore, and it would be all downhill from there. I think you got to keep in mind, if they cut rates, you got to wonder. You need to know, why did they cut rates? Were there any events ahead of time that forced them to cut rates? I don't think the Fed is going to cut rates just on their own. I think they're going to wait for some type of. I think they're going to be forced into making a cut. But when all is said and done, I do believe that the dollar is going to be crashing so badly that the Fed is going to have their hand forced, and they're going to have to tighten rates, have to raise rates as the only way to protect the dollar. So I guess my answer is the Fed's in a box, because if they lower rates from here, then you're going to kick off just natural dollar weakness, and that will coincide with some type of a negative event, whether it be a bank's going under, you get a slew of real estate foreclosures, big commercial real estate foreclosures. The Fed will be forced into a cut, is my belief. And I also believe that because of the action of the dollar, they're going to be forced into raising rates into a weak economy, which obviously is, that's not the policy they would prefer, but it's the policy they're going to have to do. Is they're going to have to raise rates to support the dollar, which, again, raising rates on such a hyper indebted system, now it's a systemic event.
Gold prices have the potential to experience sustained growth as central banks may continue accumulating reserves throughout 2024. Currently hovering around the $2,025 mark, gold could reach a new high of $2,200 by the end of the year. The consistent accumulation of gold by central banks supports its prices and provides a significant boost despite prevailing uncertainty. We would love your thoughts on Bill Holter's predictions on gold as a safe haven in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.